I got the countdown. I'm allowed to talk, and so I've been set free, unchained, unshackled melody. My name is Brian Tobin. I'm the vice chairman of the Bank of Montreal, and I'm here today with a fascinating panel that are going to explore the theme of this conference, that's scaling for a sustainable future. Sitting to my left is Robert Furdak. Robert's the Chief Investment Officer for Responsible Investment, Chairman of the Responsible Investment Committee of the Man Group. Robert, I think that's UK-based, but you're holding down the fort, cheering for the Bruins in Boston, I believe.
Yes, exactly.
Full time. Next to Robert is Jean Schmitt. Jean is the President and Managing Director of Jolt Capital. Jolt's Paris-based, but recently has opened offices in Montreal. You might tell us a little bit about that as we get into the discussion. And next to me, to my immediate left, is Khoza. Siti is the head of balance sheet at the Development Bank of South Africa. Siti, welcome. Delighted to have you with us today as well. Well, let me ask each of you, if I can, just very briefly, to give us like a minute on you and on your organization. Everybody here has been able to see your bio in the material provided by the conference, but I'd invite you, Robert, to begin.
Sure. Thank you very much. And thank you, Toronto, for having us. Sorry, I'm a big hockey fan, so sorry that the Bruins knocked the Maple Leafs out last year. So,
We're used to it. Don't worry about it.
Yeah, don't hold it against me, please. So my name is, thank you, Brian, Robert Furdak, Chief Investment Officer for Responsible Investment. So we're trying to integrate themes of responsible investment into the diverse set of Man Group strategies. So Man is a big institutional asset manager. We manage about $170 billion in mostly publicly traded securities, so stocks, bonds, currencies, commodities. We're known for alternative investments. We manage a lot of hedge funds, and incorporating sustainable themes into our strategies is a key component of what we're trying to do and trying to direct capital towards places that can A, make a difference, and B, generate returns for our clients.
Jean, please.
Yeah, so thank you. I'm Jean Schmitt. I'm CEO of Jolt Capital. What we do is relatively simple. We are all a bunch of nerds, I must confess. And we invest in complex technologies, those growth companies, which reach critical mass like 20, 25 million revenue, smallish, too big for venture, too small for private equity guys. And we grow those companies so that they become large champions where they were born. So we were investing mostly in Europe, now in Canada, as you said. And in order to grow those semiconductor, robotics, you name it, technology companies in healthcare as well, to critical mass. And before we pass the relay to some other investors. We had been doing that since 14 years. And I will explain, we had been monitoring multiple markets which are very similar in Europe, in Japan, in Korea, in Canada, where we think we can bring a lot of value.
Thank you. Siti?
Thank you, Brian, and thank you to the audience for hosting us. Very exciting for us to be here. I believe we've probably traveled the longest distance from the southern tip of Africa.
I think you have.
Here. But very exciting. My name is Sithembiso Khoza. I head up the balance sheet management unit at the Development Bank of Southern Africa. So just to give you context, we are one of 3 national DFIs in South Africa. One DFI responsible for land and agriculture, another for industry and commerce, and we are the DFI responsible for infrastructure. So our primary focus, we split it in 2. We have an economic infrastructure mandate and a social infrastructure mandate. Under the economic infrastructure, we finance energy, transportation and telecommunications. So that's to assist ease of business for commerce and industry. But also we are required to balance that with social. So there we face a big challenge of unemployment, in particular youth unemployment. So we spend a lot of time on education, health, as well as housing. So we are primarily in South Africa, but we have started to expand into outside South Africa, our neighboring states, and then further as far up as Senegal, Ghana, But that is new for us and a very fast-growing focus going forward.
Well, I'm going to put my first question to you because of your commentary in introducing yourself and the bank really raises an interesting question. There are about 5.5 people in Africa, in the continent, 65 million people in South Africa. South Africa obviously is moving rapidly to build infrastructure, has built infrastructure. How does a jurisdiction, an emerging economy, and you're assisting neighboring countries with your investments, but how does an area like South Africa, the continent of Africa, compete for the funds that these two gentlemen and others represent? Are you able to compete? Are you able to draw in these kind of partnerships when there's so much of that money being drawn into North America and being drawn into Europe?
Yeah, and that's correct. So very lucky for us, the South African government recognized very early that we have to work with partners. So we spent a lot of time developing partnerships with sister DFIs. Mainly we began across Europe, but we have started to expand that into Asia. So countries like Japan, China. We have already established working relationships with other US private investors, so the likes of PIMCO. So we target investors with a common vision, looking for assets in emerging markets, but looking to work with reputable institutions. Yes, we are government owned, but very independent in how we run the business, strong risk management. So we've demonstrated that over 40 years, the Development Bank has developed a lot of expertise around how you roll out large-scale projects. So we attract investors into the energy sector, for instance. We had a very successful renewable energy program that we rolled out that attracted private capital from within the country, as well as investors from outside. So we look to work with large international DFIs, large commercial banks, and fund managers.
So, Robert, let me ask you, and perhaps Jean, you might want to weigh in as well on this question. I'm going to come to some specific questions for you, but on this particular issue, how does your fund, and Robert, will start with you, look around the world for opportunities to invest? Obviously, at the end of the day, if there aren't healthy returns, you're not going to be there. Are you present outside of the mainstream sort of obvious markets of Europe and North America?
Yeah, so Man Group invests in literally hundreds of markets. We trade probably 500 different commodities. We're trading in almost every single stock and bond exchange across the world. So we try to have a diversified approach, and we're looking for the best opportunities. So those present themselves in different arenas. And I think one of the key things is, as you mentioned, Brian, it's really focusing about returns. Most of our clients are big pension funds, sovereign wealth funds, and they need to generate returns for their constituents, whether those are pensioners or their foundation or their sovereign wealth fund. So that's a key thing for us, is to really focus on returns. And I think the fact of the matter is some of these concepts around sustainability have had a tough 18 to 24 months. So that creates an issue for people who are who asset owners who are more sustainably oriented. But we find opportunities across the globe. And I think that, it's important to take price into account. So when something is out of favor, or a region seems perhaps too risky, that's where you have to be able to have the capital and the patience to seize the opportunity to see places in the developed world that are great opportunities. So in terms of us, we try to be very, very objective in terms of looking at the investment opportunity, and price plays a key role.
Excellent. Jean, anything to add?
We are very data driven, so we can count. We developed a big platform which is kind of finding all companies in each country which are within our target. So growth stage technology companies. And today, key countries are the ones having the largest inventory of those companies. So we started with Europe, no competition, many of those companies. So if you kind of look at what we call the innovation banana of Europe, which is starting from France and ending somewhere in Oulu in Finland, you have this innovation corridor where you have most of those companies, something like 20,000 companies which are unfunded today. So that's the low-hanging fruit. Then Japan, Korea were exciting as well. Canada is clearly very exciting with many startups which are growing and then unfunded. So for us, it's perfect. Now, to answer your question, it's not on our shopping list right now to go to South Africa or other countries which are developing real technology today, because it's still too small. We give ourselves something like 5 to 10 years to get there, and we have a few other countries on our shopping list before. But we are controlling our expansion based on the inventory of high quality companies which are already available.
Robert, let me come to you. Man Group, and I've read your material online and looked at some of your commentary in other places. You pride yourself as a highly engaged investment manager fueled, and I'm quoting here, by cutting edge technology. So my question is, how does the adoption of new technology power your business as it meets the challenges of scaling for sustainability?
Yeah, I think, Man, in essence, is a technology company. We have about 1,800 employees, and probably 800 of those are either data scientists or technology developers. So we try to be as data-driven as possible. And in some places, that's easy. If you're looking at financial statement data, there are standards around cash flow from operations or earnings or accounts receivable. When you're dealing with some sustainability data, it's a lot more subjective. So there's a little bit of art, there's a little bit of science, but we try to be as granular as possible in terms of trying to make decisions based on the data. And I think that, kind of linking data and technology to your previous question of how can we allocate capital where it has the most impact. We've recently partnered with Columbia University in the US to come up with a model to determine the maximum way to allocate capital to have the biggest real world decarbonization impact. So there you're looking at what's called integrated assessment models, where it's looking at, kind of complex relationships between society, the environment, policy, demographics, and trying to figure out what's the difference between where capital is currently allocated and where capital needs to be allocated to achieve net zero. So if you look at those differences, to cut to the chase, more capital needs to be allocated to Africa.
Right.
More capital needs to be invested in better land use. More capital needs to be invested in transportation, things like shipping and air travel. So, looking at those deviations is the first step in trying to make that. And it's a very data-driven, these models are incredibly complex, put together by governments and universities.
Are we talking machine learning or AI?
These are more traditional models, but we also use machine learning, AI, to help us along our investment process. Machine learning to help us, determine, which factors may be in favor or out of favor. We use AI to help us, instead of having a, first-year analyst go through 20 academic papers to see what's relevant, you can have ChatGPT do that, or ManGPT is our own internal, where we can put together kind of the scientific literature, we can put it together with our own research and try to, be much more efficient in our investment process. So technology is a key. We don't rely on it 100% for our investment ideas, but it can really help jumpstart things.
So at the investment committee meets, there's not a little robotic head sitting there called Chat or ManGPT making the call.
No, definitely not.
Jean, I know that you do have patented technology that you use. Do you want to tell us about that?
Yeah, as I said, you're a bunch of nerds. So we started with thinking, how can we scale a firm like ours with, not too many people at the end of the day? We don't want a call center of junior people coding all over the place, CEOs and so on. So we created this engine, which is discovering companies, something like today, since the beginning of that session, we discovered around 25 new companies somewhere in the world on which we now have a due diligence file, a pre-due diligence file. But we inserted AI everywhere in what we do. When we are in our investment committee, whatever we said is actually automatically recorded and attached to companies saying, oh, this guy said something about that company, so that we don't lose anything, and whatever is recorded is used to learn better. So I think there is a digital me in my software, which might be as good as me or better than I. We developed that, and now it's kind of in the core of our processes. So yeah, it brought a very easy scalability of the firm. So when we came to Canada, we could exactly tell you already how many firms are there in each place, how many semiconductor companies having more than 5 patents in that region do we find? And that's super effective because you know where you go, and AI at being
your target area is a specific target area for...
Yeah, we're trying to find those companies which are 10 to 50 million in revenue, something like that. By the way, we are doing one first deal in Montreal as we speak, which will be closed within days. And this is a company which is coming straight from that engine.
Okay. Technology, Citi, how is that being used by you and by the South African Development Fund as part of your assessment process? And the other question I want to ask, because of course it's a question we always want to ask when we're dealing with government agencies, wherever they are, Canada, the United States, South Africa, how arm's length is the decision-making process for the South African Development Fund insofar as governments are concerned?
Yeah. And that's an interesting one for us. And one has to be honest, we rely a lot on developed countries for technology. We have the resources on the ground. So through these strong partnerships that we develop, we seek to attract companies with expertise. So when we rolled out the solar program, there was no solar technology in South Africa. And I know Canada is one of the leading countries in solar technology. So we rely on the expertise of European for wind, etc. So we were very strong in laying down the rules for operating. The government was very transparent about how we allocate licensing for companies to have good confidence that they could come in and play. So at this stage, we are at the beginning stages, I would say, of really leveraging technology as a country and as a company. But it is something that we are learning about quite fast. And to your question on how we operate and how we protect ourselves from any interference from the shareholder, who rightly is the shareholder. So we have a very strong agreement with the shareholder that their interference stops at mandate. They give us a clear mandate, what we expected to deliver. We sign on a contract with them. But all investment decisions are made internally by our committees. We have a executive committee and a board that supports those decisions. Yes, we have a shareholder representative that sits on the board, but are not part. So business that we originate, government cannot bring any business to the company. And so they really measure and monitor our effectiveness through regular reporting. But we have a very...
And you have a hurdle rate that you must hit in terms of returns.
Yes, and because of that, so the flip side of that independence is that we are self-funding. We raise capital from the market on the strength of our own balance sheet. They don't guarantee our liabilities, so we have to be very careful what assets we put on the book. It has to be assets that are cash generating, sustainable assets. And we have differential returns. So on what we deem as more commercial transactions, we do seek to get a little bit higher return. But on the pure developmental transactions, we do take lower returns. And
so for those who are interested, 36 projects I think you've recently identified as being necessary infrastructure plays, a lot of that in the generation space and also in the distribution space. I'm talking about electricity, of course, and that's going to require partners to make all of that happen. So some interesting opportunities for some of the folks perhaps sitting in the room. Sean, let me come to you. You tell your stakeholders when I go on your website and have a look and peruse some of the material and speeches that you've given, that you invest in companies that create value through technology that focus on having a real impact because of innovation, and that avoid over use of natural resources or over exploitation of human resources as a consequence. Can you just suss that out for us a little bit?
Yeah, when we created Jolt, we all thought like we need to be doing something which is useful without much compromise. Of course, where there is no compromise as well is on returns. So we are financing technology companies because we are financing things that are obviously having an impact. We try to quantify that impact. So for us, it's $1 invested or €1 invested must be equal to 1 kilogram of CO2 saved. So a billion fund is going to save 1 million tons of CO2. That's something we committed to. And in reality, I must confess, it's not very difficult to reach that level of savings of CO2 because deep tech companies are always trying to sort out current issues. So yeah, we go after technology because we believe that returns are going to be very high. And at the same time, we are managing Article 9 funds with a very clear objective of CO2 savings and very simple. Everybody can understand.
Can you just explain for those who may not know what Article 9 funds signify?
Article 9 is those funds where you need to have a commitment on a given metric and in which you reach regarding sustainability. And so those commitments are in marble. I'm risking a part of my teams and my carried interest based on those commitments. So we are very motivated to reach those thresholds because that's quite a bit of money which we would lose if we wouldn't do that. And that's driving people to think, right, I think. But it's also the mission, which is fun.
So people like the Article 9 designation. That's good for ESG, but they also want to make sure they're going to make money, I presume.
Absolutely. And I think that's how you need to do it because, people want the good for humanity and so on, of course. But if you don't put a carrot next to it, it doesn't work as well. Here, there is a stick and a carrot, and it works really well on Article 9. That said, I see many funds, and this is why we have a hard time on ESG, is that lots of funds are having awkward metrics or very relaxed metrics. I'm helping schools, blah, blah, blah. And there is no very clear metric on which you can say, okay, the impact had been big or small. It's washy-washer. And that doesn't help. And that's the reason why we are going through a hard time. We don't market the fact that you are Article 9. We discussed it. It's a nice to have probably for some of our investors. It's very important for us as a firm because it's foundational for us. It's a way we operate. It's a way we think. But we don't sell carbon credits or stuff like that. We do it. That's it. And we don't talk too much about it. It's like the unicorn story. You can talk about unicorns forever, and you never sell any company for $1 billion. And I saw so many people doing that. Yeah. No, we try to be a little bit more modest. We don't talk about it, but we do it.
So, Robert, I can see you're wanting.
Yes, I think just to build on Jean's point is we look at this metric called avoided emissions, which kind of takes that one step further to say that not all wind and solar projects are created equal. The marginal benefit in terms of real world decarbonization of putting a wind or solar installation up in Johannesburg or in Manila is much greater than if you do it in Copenhagen or LA, because you're avoiding a lot more. If you're taking some coal offline, in some dirty plants, that's going to have a much bigger impact. And that's this concept of real world impact versus kind of portfolio impact, where you can massage things. So that's, again, we try to. That data is hard to come by, and that's a key metric in terms of really maximizing that real world impact.
Can you, and I'm curious, can you each give us some example? I mean, what I hear you saying is your investors are less focused on the ESG tick mark than perhaps Jean you're experiencing with what you're doing and the philosophy that underlies your fund. But can you give us some examples, specific examples of where the investments you've made have responded to the need to be more sustainable
So we have a series of article. These are kind of a European regulation. Which is called SFDR. Which Article 9 is the greenest, most sustainable funds. Article 8 are less sustainable but still have a sustainable objective, and then Article 6 is not sustainable at all. So we manage funds across those three different classifications, and different asset owners have different preferences for where they want to be on that spectrum. And our Article 8 and Article 9 funds are directly targeting those sustainable investments depending on the strategy. If you're running a credit fund, you probably care a lot more about governance concepts and making sure you can get your money back, or you care a lot about physical risk that your plant may be wiped out by a hurricane or an extreme weather event and you may not get paid back. So different strategies, different asset classes react differently to the different factors along that spectrum.
I can give some very concrete examples. We invested in a company which is turning pine wood, which is a soft and hydrophilic wood, into a very, very solid wood by injecting residuals from corn. And this new wood, this transformed wood, is hydrophobic and is extremely hard, harder than any tropical wood. So in a way, we have this company which is replacing a wood which you don't want to cut, which is this tropical wood, which is a carbon well, which is amazing, by culture wood, which is pine wood, and there is so many available around. So that company doesn't have a great impact by itself in its factory, on its factories, but they have a hell of an impact at scope 4, so which is indirect impact, which is amazing. Just give you an awkward example as well. Take semiconductor company. We have a company which is controlling any single NVIDIA chip on the production line. An NVIDIA chip has a carbon footprint, which is pretty high. A small microcontroller, 500 grams. A big AI chip, 10 kilograms. If you just can't stop the production of those chips in the line where you know in advance they are not going to work because there is a connection which is not done or whatsoever, you are going to save 5 or 6 kilograms per chip, which is not produced till the end of the production line. And if you add up on all the chips that had been saved, again, you find a lot of kilograms because the yield of NVIDIA is not that great these days. So you have concrete examples here of how you can save CO2 in a quantifiable way by companies, in a way indirectly, but for real.
So let me just put this thought on the table. I'd like to hear all three of your reaction, perhaps beginning with you, Siti. We're living in really interesting times. We've just had massive weather event in Florida, a series of tornadoes, 2 hurricanes, massive flooding. They're going to be a long time cleaning up from those 2 events. Record high temperatures being experienced in many parts of the world, not just in the United States. I only saw snow in my driveway twice in Toronto here last year, which is unheard of. Paid a guy to clean the driveway for 4 months. He just loved it. He thought he had a great season. And we have a presidential election in the United States where one of the main candidates, you can guess which one, his environmental policy is drill, baby, drill. That's his sustainability policy as well. Maybe I'm being a bit harsh, but not too much. Has the passion for addressing climate change, because it's there, it's real, and there are those who doubt it in this room, so be it. But to me, it's pretty obvious. Has the moment begun to pass with the election of governments in certain regions, geographies around the world, having a contrary view? Have we lost the moment? Yea or nay, or will the necessity dealing with the existential threat that it presents drive us to continue to collaborate between the private sector, governments, etc.? Siti.
Yes, I think it's inevitable. The survival instinct has to kick in. And so some of the behaviors that has brought us to where we are will need to change. Now, if you look at what you point out to what we saw with the weather conditions in the north part of the continent, and it happened in Europe, now in the Americas, in the south of the continent, we're experiencing the exact opposite.
So now, get it back.
Yeah. So we are experiencing water scarcity, droughts in most parts of South Africa. In fact, South Africa is classified as a water scarce country. I know it could be strange to someone from Canada that such an issue exists, but so what we've started to do and is invest a lot in water reuse technologies. So the DBSA, working with our national government, has put together a program where we're looking at how we can free up the little water that we do get from the sky by using a lot more of the water that we have on the ground. So we're developing reuse, recycling technologies. So industry then commits to take up that water for industrial use and free up the municipalities for domestic water. So working in these ways of innovation, I think we can tackle some of the challenges that, and we can see that those challenges are inevitable but manageable. And that's really where our technologies and working together. So as you learn in the north how to deal with floods, we are learning in the south how to deal with droughts. Right. And we can learn from each other if those dynamics switch around.
And yet in the continent of Africa, you still have up to, depending where you are, 50% of the population without access to electricity. Obviously in South Africa, that's more like maybe 20%. But generally speaking, a massive number of people out of a total population of 1.5 billion still not served, still not plugged in and wanting to be plugged in. Let me extend the same question. Let me go to our friend from Boston who's paying close attention to what's going to happen in the November 5th.
Yes. Yeah. I care a lot about U.S. politics and also about climate change because our office in Boston is basically on a pier, very susceptible to climate change. And we spend a lot of time thinking about climate. We have climate scientists on staff. And I think it's a critical threat to our society and to our economy. And if governments are involved, that's fantastic. I think that just boosts things, as we've seen, like in the IRA in the US and some of these programs in other countries that are really accelerating that spending. But I think my personal opinion, and in talking with company management, is things are going to go ahead regardless of what the government says. I think companies realize that this is a threat to their business, is a threat to their profitability. You look at the deal a couple of weeks ago where Microsoft has worked with a utility company in the U.S. to restart the 3 Mile Island nuclear plant and buy 100% of that nuclear power to power their cloud-based AI processes. So companies get it. They're going to accelerate that change. And in terms of our climate models, we kind of think about climate in 3 perspectives. The first is, what is the physical risk? What's the risk that climate is going to impact the business? And I think regardless of what state you're in, Florida, generally a red state, has been very impacted by climate change, and they realize that something has to be done. People have to pay extraordinary amounts of money to insure their homes. So physical risk is one aspect. The second is transition risk. As we transition, and I think that's an important component, we can't just get off fossil fuels cold turkey. Right. There has to be a transition. And while drill, baby, drill, we have to do some drilling and some extraction. Of course. To get to the other side. So we have to recognize that in how we think about things and who the winners and the losers are going to be. And then the third is opportunity, which is what are the technologies, what are the things that Jean sees in terms of opportunities for processes and products to really make a difference in the world. And I think the key thing is to how do you take these long range climate models that happen over decades or centuries and link them to corporate performance, where, you're thinking about what's going to happen to the stock or the bond over the next 1, 3, 6, 12 months. And I think our innovation is to try to look at facilities. So where does a company have plants? How susceptible are those to particular physical risks? And what are the potential losses if something happens? So.
Sean, did you want to jump in on
I
this?
think that we started with a hype cycle where lots of money came in, and when you have an influx of money coming, you have plenty of opportunists who are seizing this influx of money. That's what happened with the first green funds and so on. So people saw the money, they took it. Okay. Then there is, of course, after these hype cycles, there is a cycle which is going to delusion. People were thinking like, this thing doesn't make any sense. I really think that we are entering now in a place where it's there. So, and it's going to improve. So I'm very optimistic about the fact that those behaviors of being contributive are going to flourish and are going to continue. Of course, it requires CEO to drive that. So in our companies, it's always the same. First year, they complain, why are you asking me to track my CO2, indirect, direct, blah, blah. So they all cry a lot. And after kind of pushing them for a year, they discover that by being honest and reporting that, they win more deals. And their customers are pleased and so on. So it's good for business. It's just a behavior which is starting, and it goes beyond politics. I think politicians are dangerous here because when they put too much...
Now be careful.
You said it. I didn't say that.
When they put too much money on the table, they call the crooks.
Yeah.
And
Right.
we end up being in a mess. So it needs to be progressive, and I think it's good. It's coming.
Well, let me stay with you, and I'll ask your two colleagues the same question. You made reference to politicians and public policy, et cetera. We've got a few minutes left in this panel. What message do you have as an investor in the space for politicians, for government policymakers about the oversight that's currently in place? Is it effective? Is it helping? Is it harming? What would you say?
I think first, stay away from fashions. I heard so many politicians, and even recently I was in Japan, I heard the guy saying, our objective is to create 100 unicorns. No, don't do that. Over the last 20 years, the world created 2,500 unicorns, and guess what is the return on unicorns? It's 1.2x. So the lucky guy who would be able to put dollars on any single unicorn would do less than the saving bank. So don't go after fashions. Look at the reality. Go after, growing real companies, real technologies, things that are going after sovereignty and so on. That's simple, takes time. So don't look too short term. I think it's difficult for politicians. I don't know, and I'm not one, but looking short term is...
I don't know when I should tell him I spent 20 years in Parliament in Canada once upon a time. It's okay. He's bigger than me.
So being long term is, of course, difficult to ask. Then I need one more minute. It's about regulations. I heard the previous speech about, we are helping with regulations. I'm European. This is hell. Our politicians are completely confused about, being cautious and helping people. And we are in that situation where our regulators are strangulating business because they want to save people despite innovation, which means that now in our healthcare system, we don't have access to innovative healthcare devices or new treatments, because those drugs are going straight to the US, where the regulators is more amenable. So regulation, and don't follow fashions, please.
Thank you. I'm going to go to City for a quick comment. I know I put you in a difficult position because you work by way of a government mandate, but any messages about government oversight and how it helps or harms?
Yeah, so I think what we are doing as the DBSA, working with government and also in Africa, working with governments in Africa to say move with speed. Now, we do see an opportunity which I'll give you an example of telephone. Most African countries have never seen a telephone cable, and they jumped that whole technology cycle to cell phones. So this can happen in Africa, where you mentioned earlier lack of electricity. So you might have countries in Africa where the first experience of electricity is wind, solar, clean energy. So that is a great opportunity for Africa where we don't have to go through dirty the air and then clean the air. We can just leapfrog some of these issues. So, but I think African countries have to get their policies correct. That has been a challenge we've seen where we try to get into certain countries. They don't have legal frameworks, standardized approaches to how you get in. So if they can get that correct, they will leapfrog and avoid a lot of the pitfalls. I think Europe, America, and the developed countries had to go through the painful journey, but we can leapfrog that. And
Thank you.
Yeah.
You have the last word.
Last 59 seconds.
There you go.
So I think governments can play a role. I think governments and policymakers need to be accelerants and not barriers to try to encourage investments, especially in places, in the developed world or the developing world where, where there needs to be, encouragement, safeguards, to spur the development and not be overly prescriptive. The SFDR framework is Byzantine. The rules are not logical in some places. They don't recognize this need for transition, and that's a barrier. So I think, eliminate those barriers, spur investment, decrease bureaucracy, because capital is going to find the rightful home, the fewer impediments there are.
So bottom line, come hell or high water, sustainable future is coming. The business community is not going to turn away. Capital is not going to turn away. Governments can accelerate it, but not even governments can slow it down. The future is coming at us. Thank you very much, and thank you to the panel. Thank you.